Good day everyone, especially to you Sir Viola. We are the Group 4 and we will be discussing Chapter 9, Track Your Finances. So today's highlight, Finance Your Business, Pro Forma Financial Statements, Record Keeping for Business. First, assess your financial needs. Your financial needs will vary depending on the size and type of business you start with. If you are starting a very small business, you may be able to provide all the startup money you will need. If your business will be large or require special equipment, you may need to look to others for help raising the startup money. So, bago ka mag-approach ng lender or investor about financing your business, dapat mag-prepare ka muna ng some financial documents. To begin with, you should estimate your startup costs and gumawa ka ng personal financial statement. Then after that, you will prepare pro forma financial statements of each cash flow statement, income statement, and balance sheet. These items allow potential lenders and investors to determine if your business is viable. This will also help lenders decide if the financing you are requesting is reasonable. Next, startup costs. Itemizing your startup cost is an important part of determining how much money you need to start your businesses. Common startup items to be purchased including the following. First, equipment and supplies such as computers, telephones, and fax machines. Furniture and fixtures such as desks and chairs. Vehicles such as delivery trucks, remodeling such as electrical and plumbing expenses, legal and accounting fees, and lastly, licensing fees. Next, personal financial statements. Net worth is the difference in what you own called asset and what you owe called liabilities. Net worth is also referred to as equity. To calculate your net worth, dapat mag-prepare ka ng personal financial statement. Sa left side, list all your assets with their value, which include cash, investments, and any property you have. Sa right side naman, list your liabilities and total the amount of that you owe. Then, minus lang yung total liabilities mo sa total asset para ma-determine yung net worth. Next, equity capital. Equity capital is money invested in a business in return for a share in the profits of the business. Entrepreneurs may seek equity capital when they do not qualify for other types of financing and are not able to fully finance their businesses out of their own savings. So, equity capital, there are two types of financing available for your business, equity and debt financing. You must consider your company's debt to equity ratio or the relation between the dollars you have borrowed and the dollars you have invested in your business. Tinitignan ng lenders and investors itong ratio to assess risk. The higher percentage of your own money that you have invested, the easier it will be for you to get others to invest. If ang company mo is low ratio of debt to equity, dapat kang maghanap na ng debt financing. If ang company mo naman is high ratio of debt equity, you should work to increase equity in your business. Having the right mix of debt and equity will help ensure your business sound financial future. So there are three categories of equity capital. There are personal contributions, friends and relatives, venture, and capitalist. First, personal contributions. Many entrepreneurs use their personal savings to finance the start of their businesses. Investing personal finances can help you get a loan from a bank. By investing your own money, you demonstrate to the bank that you have faith that your business will succeed. Second, friends and relatives. Friends and relatives can be a good source of equity capital. They will already be familiar with your business idea and know whether you are trustworthy and a good risk. They may be willing to invest more money in your business than other sources in return for a share of the business profits. Lastly, venture capitalists. Venture capitalists are individuals or companies that make a living investing in startup companies. Some privately owned companies get financing through venture capitalists. Nagre-research sila ng opportunities that they believe will make above average profits. Usually, interested sila sa mga companies na may potential of earning hundreds of millions of dollars within a few years. The prospect of a company going public by publicly Offering shares of stocks for sales also attracts venture capitalists. Because of the desired criteria, many small businesses would have trouble attracting the interest of venture capitalists.
So I am Angeli Fernandez, and for my report is about debt capital. So what is debt capital? Debt capital is money loaned to a business with the understanding that money will be repaid, usually with interest. You can borrow money from friends, relatives, or from the banks. So example of debt capital is loans, bonds, and mortgage. So we have here the secured loans. So secured loans that are backed by collateral are called secured loans. So the most two common example of secured loans are debt and mortgage and auto loans. This is so become their inherent structure creates collateral. If an individual's defaults on their mortgage payment, the banks can seize their home. Similarly, if an individual defaults on their car loan, the lender can seize their car. So also we have collateral. So collateral is a property that the borrower, if he or she defaults on the loan. So collateral, also called as secured loans, is backed by something you own. Some of the most common types of collateral loans are auto loans and mortgage. Through other forms of collateral that can be used include savings accounts or certificate of deposit. So we have also the types of secured loans. So the first one is line of credit. So line credit, an agreement by a bank to lend up to certain amount of money whenever the borrower needs it, is called a line credit. So example of line credit, and when um, a client credit also line is a flexible loan from bank or financial institution similar to credit card with a set credit limit. A line of credit is defined amount of money that you can access as needed and as you wish. Then you can repay what you use immediately over time. So second is long-term loan. A loan payable over a period longer than a year is long-term loan. Long-term loans are generally made to help a business make improvement that will boost profits. So example dito naman is home loans, car loans, and personal loans are the perfect examples of long-term loans. In addition, long-term loans are also availed from financial institutions to meet crucial business requirements or personal needs. Such as requirements include the purchase of machinery or property. So the third one is the accounts receivable. So account receivable financing. The customer's own balances are called the business account receivable. The interest rate for the accounts receivable financing is often higher than for other types of loans. And so also the account receivable financing, a type of financing arrangement in which a company receives financing capital related to a portion of its account receivable. And the last one is the inventory financing. So inventory financing, when banks use the inventory held by a business as collateral for loan, it is called inventory financing. So the term inventory financing refers to a short-term loan or revolving line of credit acquired by a company so it can purchase product to sell a later date. So, paano bang ginagamit ang inventory financing? So, we have four process on how inventory financing works. So, the first one is determine how much inventory you need. Second, price shop manufacturers and wholesalers. Third, choose a term loan, line credit, or other financing option. Fourth is compare top lenders' interest rates and terms. And last, have your interest appraised if required. Kung meron tayong secured loans, we also have unsecured loans. So unsecured loans, loans that are not guaranteed with collateral are unsecured loans. So these loans are made only to the bank's most creditworthy customers. So, example of credit loans, example of credit loans is personal loans. Personal loans, student, yung mga tayo as students, di ba minsan meron din yung ibang students na pwede mag-loan if approved doon sa bangko na maglo-loan ka. So, personal loans, these are general purpose loans that can be used for various personal expenses such as weddings, home improvements, medical expenses, or any unexpected expenses. So, also, example of unsecured loans is credit cards. Credit cards are a form of unsecured revolving credit. So, why it's called unsecured loans? So, unsecured loans is a loan that does not require you to provide any collateral to avail them. It is issued to you by the lender on your credit worthiness as a borrower. Having an excellent credit score is a prerequisite for the annual of loans. So we have reasons a bank may not lend money. So we have 5. So the first one is the business is a startup. Second, lack of solid business plan. Third, lack of adequate experiences. Fourth is lack of confidence in the borrower. And the fifth is the inadequate investment in the business. So we also have other sources of loans. So small business administration, small business investment companies, minority enterprises, small business investment companies. Fourth is the Department of Housing and Urban Development. Fifth is the Economic Development Administration. Sixth is the state governments. And the last one is the local and municipal governments.
Hello everyone. So my topic for today is all about cash flow statement. So what is cash flow statement? It is an accounting report that describes the way cash flows into and out of your businesses over a period of time. It deals with actual cash coming in and going out of a business. And it shows how much money you have available to pay your bills. So basically, ang cash flow statement, it helps you to see kung saan galing yung pera mo, kung saan mo ito ginagasto, and how you're using it para to keep things running smoothly in order to grow your business. So the cash flow statement has its 3 steps. So the first one is forecast receipts and disbursements. The second is prepare the cash flow statement. And lastly, the economic effects on cash flow. So the first step is the forecast receipts and disbursements. Estimate monthly cash receipts and monthly cash disbursements. So cash receipts include cash sales, collected amount receivables, tax refunds, and funds from bank loans and investors. So to forecast the amount of cash receipts, you must first need to analyze the demand for each of your products and services. Number 2, you also need to know the price you will charge for each item. So dito sa cash receipts it includes cash sales, collected amount receivables, and tax refunds. And dito sa cash receipts is kailangan mo muna i-analyze kung ano yung demand ng mga tao sa mga product na binibenta mo as well as sa services. Kailangan mo rin malaman yung price na i-charge mo sa mga products na ibenta mo para di malugi yung business mo. So the next one is the cash disbursements. It includes payments for cost of goods, accounts payable, rent, salaries, taxes, office supplies, utilities, insurance, advertising, loans, and other expenses. So the next step is prepare the cash flow statement. Prepared after making projections of cash receipts and cash disbursements. Monthly pro forma cash flow statements should be created for the first year of operation and annual statements. Annual statements for the second and third years to give your lender an accurate picture of your cash flow over time. So, the formula would be cash receipts minus cash disbursements, then you'll get the net cash flow. If the cash receipts is greater than your cash disbursements, then you'll have a positive cash flow. On the other hand, if your disbursements is bigger or greater than the cash receipts, then you'll get a negative cash flow. Then there are two types of cash flow statements. The first one is the worst case scenario wherein you should project lower cash receipts and higher cash disbursements. So on the other hand, the best case scenario, you should project the highest cash receipts and lower cash disbursements your businesses is likely to have. So the last step would be the economic effects on cash flow. Changes in the economy can have a dramatic effect on the cash flow of a business. So an example nito is when there is an economic distress resulting from income loss, unemployment, job instability, and economic insecurity. So in 1990, it is the year of good economic times wherein many businesses saw large amounts of cash flowing into their companies. While in September 11, 2001, economic slowdown happened, which caused many businesses to experience unexpected negative cash flows. So to sum up my report, the cash flow statement is an accounting report that describes the way cash flows into and out of your businesses over a period of time, wherein it has three steps. The first one is to forecast receipts and disbursements, which are the cash receipts and cash disbursements. Then the second step would be prepare the cash flow statements. And the last step is the economic effects on cash flow. That's all. Thank you for listening. Bye.
Income statement. So income statement, they are sometimes called the profit or loss. While the cash flow statement deals with actual cash coming and going out, the income statement naman shows revenues that you have not yet received and expenses that you have not yet paid. It can help examine how sales expenses and income are changing over time. Can forecast how well your business can expect to perform in the future. So parang through this, you can make assumptions about what your business would be look like in the future. Next, it can analyze your costs to determine where you may need to cut back. So, you can have the record about your cost expenses if nagkakaroon pa ba ng proper allocation with your operation. You can also identify categories of expenditures you may want to increase or decrease. So, you can assess the cash flows within your business. Like for example, in advertising, you will know if or you can identify if mag-i-invest ka ba for brand awareness or baka you need to minimize kasi baka you have a lot na na-invest na pala but wala ka namang kinikita. Pro forma income statement. So in preparing a pro forma income statement, it helps you see the growth of the business. It consists of revenue, the cost of goods sold, gross profit, operating expenses, net income before taxes, and net income or loss after taxes. So the value of the goods or services of business sells to customers is what we call the revenue. This is the amount after nabenta yung goods or yung services that the business offered to the customers. Next is the cost of goods sold. These are the cost of inventory a business sells during a particular period, and it is listed separately from other expenses. These are the direct materials used in the operation of the business. So we have here the example of income statement, which is the gross profit is the difference between the revenue and the cost of goods sold. Next is the expenses necessary to operate business such as the salaries, the rent, utilities, advertising, supplies, and other expenses. It is what we call the operating expense. Net income before tax is the amount remaining after cost of goods sold and operating expenses are subtracted from revenue, and so it shows how much you earn before taxes. Taxes. These are usually listed separately from other expenses. So, this helps businesses to operate legally. Net income or loss after taxes. So in income statement, after taxes are subtracted, the result is the net income or loss for the period. So if negative yung total, then it would be a net loss. While if positive naman, then it is net income.
Hello everyone, my name is Amir Hamza G. Kamil. So next is balance sheet. List what a business owes, and how much it is worth a particular point in time. So balance sheet ay list kung ano ang meron sa isang business, like kung magkano assets, magkano ang liabilities in a particular time. Dapat ang amount ng assets ay equivalent pag inad mo ang liabilities at owner's equity. Types of assets. Businesses separate assets into two. Fixed assets are those that will be used for many years, like buildings, furniture, and computers. So, types of assets, ang mga businesses siniseparate ang assets into two types. First is the fixed assets. Ito yung mga assets na ginagamit ng business for long term, like in years tulad ng buildings, furniture, and computers. Current assets are cash and other assets that can be converted into cash, and items used in normal business operations. Another example of this is accounts receivable. So, current assets, ito yung type ng assets na convertible into cash and ginagamit sa normal business operations. Example dito ay accounts receivable and cash. And next is types of liabilities. Its types are separated into long-term and current liabilities. Current liabilities are debts payable within 1 year, while long-term liabilities are debts payable over a longer period. A special kind of liability is accounts payable, which are owned to vendors for merchandising purchase on credit. So, liabilities ang kung magkano yung utang or binabayaran ng business mo, like bills and other taxes, na nakaseparate din ito into two types. First is one is the current liabilities. Ito yung um, mga utang ng business or company mo na payable over a long period. Ang tawag din ay long-term liabilities, which is the second type of liabilities. Example ng liability is ang accounts payable. Ito yung kind of debt na meron ang isang customers sa business or company. Next is asset reductions. The amount a company estimates it will not receive from customers is known as the allowance for uncollectible accounts. So ito yung amount na estimated ng business na hindi niya ma-receive sa customer. And ang isa sa tawag dito ay allowance for uncollectible uncollectible accounts. Depreciation is the lower of an asset's value to reflect its current worth. So ito yung tawag pag ang isang asset is nagbaba na yung value rather the original price. And the last is pro forma balance sheet. So as you can see, this is the example of a balance sheet. Sa top nakalagay ang name of business and the month, date, and year. Sa left corner, is nakalist ang assets. Mauuna ilista ang current assets always. After that, i-compute and ilagay ang total assets. Next, sa right corner is the liabilities. Same as the assets, mauuna ilagay ang current liabilities, then ang long-term liabilities or the non-current liabilities. Sa nang sa liabilities is the owner's equity, and after that you need to add the liabilities, and you need to add the liabilities and the owner's equity. If same amount ang total ang liabilities and owner's equity sa assets, doon mo malalaman na balance siya.
Let's proceed to 9.3 record keeping for businesses. Key recording transactions refers to the process of systematically documenting financial activities of a business or organization in its accounting records. This process involves identifying, analyzing, and summarizing transactions such as sales, purchases, expense, and payments. So a transaction is any business that changes assets, liabilities, or net worth. Transactions are typically recorded in journals, ledgers, or electronic accounting systems using standardized formats and principles. One of the methods of recording transactions is through journals. And journals are accounting records of the transactions you make. So there are 5 different journals that businesses use to record their transaction. First is the sales journal. Ang sales journal, it is used to record only sales of merchandise on account. Second is the cash payments journal. It is used to record only cash payment transactions. Third is the cash receipts journal, used to record only cash receipt transactions. Fourth is the purchases journal, that is used to record only purchases of merchandise on account. And last is the general journal, that is used to record any kind of transactions. So another method is the ledgers. So businesses also use a general ledger that is made of accounts. An account is an accounting record that provides financial detail for a particular business item such as for cash, sales, rent, and utilities. And these accounts provide financial details and track transactions related to the respective items. So there are types of ledgers. First is the subsidiary ledgers. Ang subsidiary ledger is a detailed record of specific accounts within a larger category. It is commonly used for accounts payable to show in detail the transactions with each vendor from whom merchandise is purchased on account. Another one is the aging tables. An aging tables is a record-keeping tool for tracking accounts receivable. And this helps businesses para ma-monitor and ma-manage nila yung receivables by identifying overdue payments and assessing their collection efforts.